Assalamualaikum everyone, my teammates member are Nazrin, Isma Atika, Ain, Sabila and Diana. So let's move to our short introduction of our selected company. Gamuda Berhad was established in 1976 and is headquarters in Petaling Jaya, Malaysia. It's a global engineering, property and infrastructure company operating in 9 countries as shown and recording a revenue of around 3.5 billion USD, showing strong growth. The company is known for a large-scale infrastructure projects such as Central Causeway Bridge, Hamad International Airport, Gamuda AI Academy and more shown in our slide. IJM Corporation Berhad, established in 1983 and based in Selangor, is one of Malaysia's major conglomerates. IJM operates across construction, property development, manufacturing of building material, and infrastructure concession. The group operates in 9 countries as shown and generates approximately 1.4 billion USD in revenue. IJM has completed major projects such as West Coast Expressway, East Coast Rail Line, ECRN, and more in our slide.
Assalamualaikum, I bid to Madam Linda. My name is Muhammad Azin Shazmi bin Muhammad Suhaimi, and I will be presenting the capital structure with a comparison between Gamuda Berhad and IJM Corporation Berhad. First, let's understand what capital structure means. Capital structure refers to the mix of debt and equity financing that the company uses to fund its operation and assets. A well-balanced capital structure helps companies manage financial risk, control the cost of capital, and maximize firm value. Capital structure is important because it helps balance funding for growth, provide insight into a company's financial health, allow investors to assess risk and stability, and support long-term strategic decisions. Moving on to our comparison. Both Gamuda Berhad and IJM Corporation Berhad rely on a mix of debt and equity. To analyze their leverage, we use the gearing ratio, which is calculated as total liability divided by total equity multiplied by 100. Looking at the data from 2022 to 2024, Gamuda Berhad's gearing ratio increased significantly, reaching 133.18% in 2024. This indicates a high level of financial leverage. The increase is mainly driven by Gamuda's expansion into large-scale infrastructure projects such as Ulu Padas Hydroelectric Dam, hyperscale data center, and major transportation projects like the Zichi Donghu MRT in Taiwan. In contrast, IJM Corporation Berhad shows a more moderate and stable gearing trend with a gearing ratio of 88.32% in 2024. This suggests a more conservative approach to debt. IJM's stable leverage is supported by its diversified operations across constructions, property developments, and infrastructure, including projects like the logistic hub in Shah Alam and a semiconductor manufacturing facilities. In conclusion, Gamuda Berhad adopts a more aggressive growth-driven capital structure, while IJM Corporation Berhad maintains a relatively stable and lower risk financial position. Both approach reflects their different strategies and risk tolerance.
Next, I will be presenting the analysis of dividend policy for IJM Corporation Berhad and Gamuda Berhad. A dividend policy is the framework a company uses to decide how much profit to distribute versus retain. According to the Modegani and Miller M&M theory, dividend policy should be irrelevant to a firm value. However, our assessment shows this theory is inapplicable here. In reality, dividends are vital signals. IJM Corporation used a residual dividend policy, prioritizing capital for investment before paying out. In contrast, Gamuda Berhad applied a flexible policy alongside a dividend reinvestment plan, giving shareholders the choice to reinvest. Both companies use dividend as a tool to manage expectation, proving they are far from irrelevant. Moving to the data, if we look at the chart for 2022 to 2024, the dividend pattern is not consistent. For IJM Corporation, the payout ratio spiked to massive 178.70% in 2023 before dropping to 46% in 2024. Gamuda show similar fluctuation, with the dividend growth rate hitting 316.66% in 2023. This figure indicates a significant instability number, suggesting that neither company maintains a stable fixed pattern, but instead it is just based on specific financial event. Why the instability? Gamuda 2023 spike was driven by the 1 million ringgit gain from disposing of its highway concession like Kesas Island truck. This allowed for a special 50-cent dividend. As they shifted focus to international construction and digital infrastructure, the market responded. The stock rose to 8 ringgit and remained healthy, trading above the 200-day moving average, with an all-time high order book of 38 billion ringgit and massive rail project in Australia. Analysts now view Gamuda as a strong buy. For ICM Corporation, the high performance in 2022 was due to one of disposal gain from selling its plantation business. This mindful allowed 21-cent dividend. Even when earning normalized in 2023, the company used retained earnings to support dividend, keeping investor confidence high. This strategy worked where IGM share price showed a strong recovery, rising from 1.50 ringgit to 3 ringgit by the end 2024, as investors shift focus toward their new expansion into high-value data center project. In conclusion, while the dividend trend were volatile due to asset sale, both companies successfully used those gains to shift to the high-growth future.
Next, I will explain the weighted average cost of capital or WACC, including its definition, importance, cost of debt, cost of equity, final result WACC, and analysis. Firstly, WACC refers to the average cost a company pays to finance its asset using a combination of debt and equity. It represents the minimum return that a company must earn to satisfy both its lender and shareholder. In other words, WACC acts as the firm's required rate of return. In terms of importance, WACC is widely used as a benchmark or harder rate in capital budgeting decision. A project is considered value creating if its expected return exceeds the WACC. This is especially important for capital-intensive companies such as construction and infrastructure firms, where projects involve a large upfront cost and low payback periods. A lower WACC allows companies to undertake more large-scale projects while still enhancing shareholder value. Next, the cost of debt refers to the interest cost a company pays on its borrowings. Since interest expenses are tax deductible, the cost of debt is adjusted to a post-tax basis. Based on the result, Gamuda Berhad recorded a lower post-tax cost of debt at 1.69% in 2024 compared to 3.69% for IGM Corporation Berhad, indicating that Gamuda can borrow at more favorable rates due to stronger lender confidence. Moving on the cost of equity, this represents the return required by shareholder and is calculated using the capital asset pricing model or CAPM. The cost of equity is generally higher than the cost debt because shareholder bear higher risk. In 2024, Gamuda cost of equity was 10.47%, while IGM was slightly lower at 9.95%, reflecting differences in market risk perception and beta values.
Next, WACC trend. Both Gamuda Berhad and IGM Corporation Berhad experienced their highest WACC in 2023, largely due to the significant increase in the cost of equity during that year. Gamuda's WACC increased from 5.17% in 2022 to 7.55% in 2023, before declining to 4.88% in 2024, while IGM's WACC rose more sharply from 5.47% to 9.83% in 2023, before easing to 6.19% in 2024. Across all 3 years, Gamuda consistently maintained a lower WACC, demonstrating greater financing efficiency and stronger overall capital structure compared to IGM. The WACC calculation clearly shows that Gamuda is better positioned to execute capital-intensive and long-term infrastructure projects. The company's proven track record in successfully delivering major projects such as the Ulu Pedas Hydroelectric Dam in Sabah, the Penang LRT Mutiara Line, and rail infrastructure project in Taiwan and Australia, which strengthened investor trust and reduced credit risk. Because of this, Gamuda is able to raise capital at lower interest rates, contributing to a more efficient financing structure. Furthermore, Gamuda's lower price earning ratio and strategic expansion into high growth areas like hyperscale data center development at Elmina Business Park further enhance investor confidence and long-term value creation. In contrast, IGM Corporation Berhad's higher WACC reflect a more conservative operational and financing profile. IGM focused on industrial and domestic projects such as the West Coast Expressway, Kuantan Port expansion, and various local development. While this strategy supports stable and consistent performance, it limits IGM's ability to undertake highly capital-intensive, high-risk projects. Therefore, IGM's overall financing position is less flexible than Gamuda's, making Gamuda better equipped to pursue expansionary high-return ventures.
In conclusion, based on our financial analysis, it's recommended that Half Free PLC invest in Gamuda Berhad due to the clear impact of its capital structure, investment value, and long-term return potential. Although Gamuda recorded a higher gain ratio 133.80% in 2034, this indicates strategic use of leverage to support the large-scale domestic and international infrastructure project rather than assessing the financial risk. Importantly, this higher leverage is offset by Gamuda's ability to secure low-cost debt, resulting in a lower post-tax cost of debt and a weighted average cost of capital of 4.88%, which is significantly lower than IGM Corporation Berhad WACC of 7.75%. Overall, the evidence showed that Gamuda Berhad offered a more favorable risk-return trade-off for investors seeking long-term value creation, supported by improving dividend sustainability and strong future project pipelines. Gamuda Berhad is the preferred investment choice for Offway PLC. Thank you.